All right. Well, thank you everyone for joining today. So we're really excited to be joining the second annual SFA ESG Symposium. So we have a great panel today, really looking to explore the application of ESG ratings, rankings, and research, and have different perspectives coming at this from the research side, structuring side, and investor side. So before we get into the panel, I'll introduce myself briefly and I'll let the panelists introduce themselves as well. So I'm Charlotte Payro. I'm leading the sustainable banking activities for Credit Agricole CIB in the Americas. And very excited to be with everyone today. So with that, Alex, I will turn it over to you to begin the introduction and we can go from there.
Yeah, sure. Thank you. Hello, everyone. Alexander Bachvarov, Bank of America. I'm responsible for non-US structured finance research. That's easy.
And Natasha?
Hi, everyone. Good morning. Natasha Akins. I'm with Fitch Ratings. I work in the sustainable finance team, and I liaise with our structured finance group for our global ESG efforts within the structured finance space.
Excellent. Thank you. And Elizabeth?
Hi, everyone. I'm Elizabeth Seep. I'm a part of MSCI with the ESG research team with a focus on fixed income products.
Excellent. And John?
Hi, I'm John Napalo. I'm a principal in PGIM's fixed income securitized products team. I head up the CLO and asset-backed securities research efforts. I'm also a voting member of the ESG committee for the firm and help shape the firm's ESG charter and our ESG impact rating methodology.
Excellent. Okay, so Elizabeth, I'm going to start with you just to set the groundwork for this conversation. And since MSCI has long offered its ESG ratings, can you give us a sense of how ESG rating agencies assess companies and how this has evolved over time?
Sure, happy to. We'll dig into a little bit about ESG ratings as well as some of our client ESG strategies as well. So I don't think ESG ratings have changed a lot when it comes to the rating methodology itself. We tend to have a letter grade that looks like what you're familiar with from the credit rating side. This letter grade is at the issuer level, whether it's corporate or sovereign. And those rankings or ratings are based on the ESG risks and opportunities that the issuer faces. And those ESG risks are deemed material by different industries. And the idea is really to highlight, which companies or sovereigns are ESG leaders or laggards by industry in the corporate section. So that's what has not changed. What has changed in the last several years is really the amount of data that's available, both whether company disclosed or from alternative sources. Also, the amount of interest from corporates themselves about what their rating is, as they've noticed that a ESG rating can impact perhaps their cost of capital or their investor base. And another thing that's changed is really with those two things, the amount of disclosure increasing is our ability to really look at more private companies and different asset classes that can be covered with ESG. So obviously ESG ratings, inputs evolve more than a credit rating. We consult with our clients, the largest asset managers, asset owners, et cetera, once a year to show them what we think should change in the methodology for a given year. For example, this year we made some big changes in our governance pillar, the G pillar. We made some big changes to update our methodology when it comes to the financial sector. We also added a key issue, which we often do. We added a key issue around community relations, particularly in the extractives and oil and gas industries. So that's overall, kind of what an ESG rating is. As far as ESG strategies, I think Jennifer showed us earlier in the survey results that ESG integration is the #1 ESG strategy, and we find that's true in the US in particular. Tends to be a little bit more values in Europe, followed by ESG integration. But I think we're all familiar with the main 3 strategies, which are 1, values-based, 2, ESG integration, or 3, an impact strategy. So I would put those all under the umbrella of sustainable investing. So the most interesting strategy that I really wanted to just kind of touch on today for this group is really how all of our clients are focused on a climate strategy, either as a standalone strategy or as an overlay to a more ESG integration strategy. We're really at an inflection point today where the promises that were made in Paris in 2015 now have to be implemented both by the corporates and the institutional investor community, as well as sovereigns. So, our clients have a few strategies when it comes to climate, exclusion strategies, optimization strategies, tilts. None of these will probably be enough alone to meet those Paris goals. So a lot of work to be done in the near term.
Okay, excellent. Thank you so much for that. So John, flipping to you from more the investor perspective, how have you seen the application of ESG information, data, et cetera, be changed or applied over time? So what does that change look like?
Sure. Yeah. So from my credit research perspective, we have always, gone beyond just the G and the governance aspect of evaluating a company or securitization capital structure. We certainly have focused a lot on the S and the utility of the loan. So as part of thinking about what makes a good securitization structure and good transaction performance, we've always asked, does the customer need the loan? Does the issuer, the loan make sense for the issuer and how they're monitoring it, underwriting the loan, as well as from the borrower perspective. We think good loans make for less volatility and less regulatory impact upon a particular company. And so we've always had this strategy. We've formalized it a number of years ago and wrote a white paper on it about almost 2 years ago, related to how we think about ESG from a securitization perspective. So, it's been part and parcel of our DNA for, I'd say, almost my entire career within securitized products. We've only just begun calling it ESG as that nomenclature has become more relevant. Over the past year, we've established a formal ESG group. We are required to put an ESG rating for every issuer that we invest in. And we spent a great deal of time across fixed income disciplines looking for consistency in ESG ratings for investment grade, high yield corporates, munis, sovereigns, and securitized products. And so we're trying to, as a firm, to come together and think about how do each of the issuers in the CUSIPs, relate to each other, and how should they all be rank ordered across a continuum? Because as we think about developing ESG funds, as well as answering client questions on particular issuers or their portfolios, we want to make sure that we're consistent across all the different investing aspects that we have. We made a specific choice in ESG ratings. So we have something called an ESG impact rating, which is different from a credit rating. So, we view that, we rate every firm and every investment, from a credit perspective, and we use the traditional nomenclature of AAA all the way down to CCC. And we think about, what's the probability of default, the amount of recovery associated with that, as many investors here do. But we separate ESG and we just think about that impact rating, and just think about ESG in and of itself. So you can have a very highly rated credit, but it could be very bad ESG. Similarly, you could have a very lowly rated credit, but it'd be very positive ESG. And we bifurcate the two concepts as we think about how we evaluate any particular investment. I think from there, we also have done a lot more in terms of our engagement with companies over the past years and asking them about ESG and asking them what their ESG policies are, as well as do they have ongoing ESG update reports that they publish. Some firms, I think, have been very good, particularly CLO managers. ABS issuers, I think, are sort of a little bit behind, but certainly coming up. There's certain ones that we have very regular dialogue with and are very positive on. Others, the concept of ESG is still very new to them. I think just from the overall rating sort of research availability, the rating agencies have all inquired ESG focused firms, and they're all introducing ESG commentary into their research report for securitized products. There are a growing number of regular street generated ESG centric research pieces. much more on the corporate side and thematic pieces, but very little, if any, on the securitized product side. I think PGIM, like other asset managers, continue to publish ESG content on their websites. So it's improving in terms of the amount of overall research that's out there. But I think, for securitized product basis, we're still behind.
Okay, very helpful. So Natasha, I'm going to flip to you. And I know that Fitch recently rolled out the ESG relevance scores. Could you tell us a bit about this and how you see this helping to develop the market?
Sure. Thanks, Charlotte. You're right. We actually rolled out the relevance scores last year. So in 2019, I think it was just before the first symposium, actually. And we wrote it over our 67. We wrote over 67,000 individual scores across our 4,800 transactions and programs. So the entire global structured finance portfolio. And really, our approach here is different than ratings. So we do call them ESG relevance scores. And the relevance scores are considered over 14 to 15 elements. For structured finance, it is 14 ESG elements, and our sovereigns has an additional. So that's actually 15. And these factors are scored based on their relevancy or materiality to the credit decision when you're looking at ESG. So the scores range from 1 to 5, 1 being the least relevant to a transaction, and the score of 4 or 5 is what we call elevated or highly relevant to a transaction. One of the things the scores do not highlight, so we don't identify whether something is sort of good or bad ESG, but what we have identified is ESG related items that are relevant in our structured finance rating decisions. To note is we've always in our rating criteria really considered what we call ESG, and I think as John alluded to, it is now, with the identification of calling things E, S, or G, we're really just bringing that transparency into items that we have actually always considered within our rating methodology. So we think this provides, market participants a guide to understanding ESG from a credit perspective and within the structured finance space. And, we hope this insight and sort of this understanding and this approach will help to give insight into the nuances of structured finance deals.
Okay, excellent. So kind of picking up on that as well. So last year's symposium, there was a discussion around the importance of a common language or standardized data reporting around ESG topics, particularly within the structured finance space. And as we've already been discussing, there are different approaches. So where do we think that there are potential drawbacks from the various types of approaches, or where are there areas for improvement, or what can we learn from other sectors or other approaches for different asset classes currently? And I'll open that to the full group if anyone has any thoughts there.
Well, if I may, effectively, ESG is a labeling exercise to a large degree, which means that there should be certain criteria. They should be to some degree or a large degree quantifiable and reportable. The question is how this criteria are verified, so everybody knows that they are adequately met, and how the data is made available. So one of the discussions that we're having a lot in Europe now is whether there is a precedent which can be used, and I'm afraid there is, probably not the best one, but Europe went the route of STS, or Simple, Transparent, Standardized Securitization, which is another form of labeling exercise where the criteria were established, 102 criteria by regulatory framework. Actually, there are additional 8 criteria depending on whether we're looking for certain other type of compliance and regulatory capital liquidity treatment. This criteria can be verified by an outside party, which is effectively a third-party verification agent approved by the securities regulator, the ESMA in Europe. Then there's a reporting framework, which is through the European Data Warehouse and the templates established by ESTA. And then we are going to see repositories, public repositories, where the data and the respective information about the transactions of securitization transactions will be posted from sometime second half next year. That is kind of a framework which some regulators are considering about replicating in the ESG securitization framework. So in fact, the European regulators are supposed to report on a sustainable financial securitization framework, or sorry, sustainable finance securitization framework by November next year. And in the meantime, the regulators are supposed to establish a methodology and presentation or information about the implications, the sustainability or environmental implications of securitization transactions, and that is coming potentially in March. My concern is that if we're replicating the STS framework, it's quite complex, very often does not allow much flexibility, and it's a very wide framework with lots of reporting requirements, which are also very difficult to satisfy for everyone. Everybody who is following the market knows the story with the templates, estimate templates, and the complications around them. So in my view, labeling framework is probably necessary for ESG to realign things across the markets and the definitions and understanding whether the European STS labeling framework that exists is the best way to go. I'm a bit doubtful, but we may have to, and we may end up with something similar with for ESG in Europe.
So any other thoughts from anyone else on that? Otherwise, I have a follow-up question for Alexander.
Sure. This is John. To chime in, I mean, I think what I've seen in 2020 is that, we as an industry have talked about, developing a common understood taxonomy. Both the SFA as well as the PRI have surveyed securitized product stakeholders. They have, process of publishing reports have put out, the results of those surveys. But we really haven't yet to come together as an industry and define what is the relevant needed information, how the information should be calculated across asset classes and report in a consistent manner. What do asset managers need in order to report to their stakeholders, clients, regulators, internal groups, and what information is really need to be provided by the issuers? I think if we don't sit down as an industry and try to develop best practices, I think, best practice will be imposed upon us either through a regulatory framework or certainly by our clients.
Very good point. So just on kind of the European perspective, Alexander, so with the development of the EU taxonomy, the classification system that's helping to define green in the context of green finance or sustainable finance, how there has been some concerns of areas that possibly are seen as a little too restrictive, whether that's on the green mortgages side of things. Do you want to speak to that at all, or are there any other examples, again, of overcoming potential hurdles when it comes to classifying green versus maybe non-green activities, and again, the view of regulation or these taxonomies?
Sure. I mean, let me, if possible, give a few kind of sentences about what the taxonomy is all about. I'm not sure how knowledgeable people would be across the Atlantic about it. So very briefly, it's effectively a unified classification system about sustainable finance. It has 6 objectives, very clearly defined: climate change mitigation, climate change adaptation, sustainable use and protection of water, pollution prevention, protection and restoration of biodiversity, and so on. It has 4 economic activities which are defined. One is to incorporate these objectives I just mentioned. The second one is known as DNSH, which means do no significant harm. in any way to the environment or to the environmental objectives. It has the requirement for minimum social safeguards of all these activities, and their requirements to meet certain technical screening specifications. And then, as I mentioned, there are three environmentally sustainable activities. One contributes substantially to one of these 6 objectives I mentioned. Second, one of the transition activities, how do you move from the current situation to the more climate neutral economy, and the enabling activities which are needed to achieve that transfer or that transition. It all sounds good in practice, nothing wrong with any of these objectives. I'm sure everybody would agree with the objectives and the activities. The devil is always in the detail. And one of the common aspects of movement now is related to mortgages, as you mentioned, green mortgages. The question is, what is a green mortgage? How is it established? How is it promoted? And here where we get into quite a few variations. So the first point, green mortgage is clear. It's all about climate change mitigation and adaptation, no doubt about that. It's all about reducing of carbon emissions. But how do you define it? What are the criteria? And probably the most clear established label, we're getting back to the label, is the so-called energy efficient mortgage with a EPS rating, which is considered one of the most best established in Europe. When we start, however, looking from one country to the next, we're seeing variations in degrees. So, for example, in the UK, EPA runs from A+ to G, has 6 levels. In Germany, it runs from A+ to H. It has 9 levels. If you go to Australia, you have 10 levels of the green mortgage or the energy efficient mortgage. Where do you draw the line? In Australia, they have come with the idea that 6+1 is green mortgage, or anything above 6 or 7 is a green mortgage. In Japan, it's a bit more complicated. They have gone further, and actually UK is already going further because they're looking beyond the green mortgage. If you look at the criteria which I just mentioned in the objectives, it's not only about carbon emission and energy consumption reduction, but one can start talking about quality of living or sustainable living. So in the UK now, we're talking about Code for Sustainable Housing. In New Zealand, they're talking about healthy home regime. In Japan, they have gone even further because they're adding energy, earthquake resistance, facilitation of elderly, and durability and flexibility of living. So you see how many variations we're having here. The next issue is that taxonomy is not meant to be constant. It is supposed to evolve. In many cases, we're looking at establishing best practices today. We're probably 25 to 35% better than the average. Once we move the average further higher, and then the whole taxonomy will probably tighten and the criteria will get tighter. That raises questions about what is ENG today, labeling, whether it will be ESG for the life of the transaction, whether it will be a green mortgage for the life of the transaction. How about the related securitization? So we are talking already about potential risk, about falling off a cliff, and how the grandfathering can be handled. The next issue, we're looking at potentially whether the green mortgage is a better quality mortgage. So effect on affordability, effect on valuation and loss given default, and so on, and potentially the differentiation there. The third issue, in my view, is we're going to end up with some form of proportionality. If we assume that one securitization is green because it has all the assets being green, it may take quite some time to build up totally green assets. If another product based on assets is using only the proceeds application as being green, but the assets themselves are not, we're effectively creating discrepancy, in a way, discrimination between two products. And I can see easily happening that in Europe, if we have covered bonds relying on mortgages where the proceeds are used for green mortgages, but not the current pool, taking off and building a massive volume and liquidity and acceptance and so on. On the other hand, for mortgages, if we currently use the only green assets can support green securitization, that means that we may have to wait quite some time. As John mentioned earlier, there is not much research. I think we are probably one of the few who have written a bit more detailed, but there are also very few deals to write about. So it's a bit tricky. So these are all issues that we have to address one way or another. I think in Europe, we may be a bit behind in a sense of creating industry standard. It's probably going to come from above.
Okay, very interesting. Thank you for laying that all out. So John, I have another question more from the investor perspective. So looking back at the engagement survey results, we saw that when it comes to structured finance, it's clear that this market is poised to take off. But there's a bit of a disconnect in that 95% of the investor respondents noted that they're currently applying some type of ESG framework to make their investment decision. And then on the other hand, 88% of issuers said that they do not currently have a securitized product or program that's targeted to ESG investors. Granted, of that 88%, 43% said that they are developing one. But how do we kind of look at that difference? And do you think that's representative of the broader market as far as how investors are looking at this and what is available in a strictly kind of ESG focused sense? Where do you see the greatest opportunity? And if you could just provide your input there, that would be great.
Sure. Well, I'm not sure if 5% of asset managers have a formal ESG framework. I suspect, ESG-centric questions are now standard for all RFPs. So I suspect every firm is beefing up their ESG-related responses. But to put together a formal ESG framework takes a lot of time. And I'm not sure how many firms have actually customized it to securitize products. I believe every issuer, should realize that they're being scored from an ESG perspective. And despite the current opaqueness of what information they need to provide or should provide, they need to develop an ESG framework and their relative, related updates to their ESG process. Some firms have done this in the consumer space. Others have, I think still a long ways to go. I don't believe ESG funds have impacted securitized product spreads to date, but with the amount of ESG labeled funds being created and money, is trying to be raised, I think the issuers that are higher ESG rated will clearly benefit and their cost of capital should decrease. I also think their spreads should compress and tighten over time. So if you're looking at, an ESG, a highly rated ESG firm, there could be some, market value growth in that, so total return that you could play. The extent of that spread compression, really will be the degree which ESG money displaces non-ESG specific mandates over the next 3 to 5 years. I think a lot of people are bringing funds online. Really, there's a question of, will this be sustainable and how much money will go to in these funds? Because once you can start saying, we're not going to invest in your issuance because it's not ESG enough, then that will certainly impact people's behaviors. But I think overall, the benefit of ESG is to sort of bring stability to the marketplace, because I think the S component, especially for securitized products, and thinking about the utility of a particular widget that goes into a securitization, certainly is important. There was a famous quote back at the beginning of the great financial crisis where someone said, a good loan is any loan that can be securitized. Really, it really comes down to what is the utility of that loan. I do think, in 2021, we're going to see more label bonds, whether it be green bonds, social bonds, sustainable bonds. I think, issuers are going to be beginning to realize that demand for these label bonds, is important. Freddie has a green program. There are some European asset managers that have ESG CLOs. So I think as you see the growth in ESG funds increase, the demand for label bonds will increase, issuers will take notice. But I think this puts an onus on investors to measure the impact and the credibility of green, social, and sustainable for any issuance that's out there.
All right, excellent. I don't know, Elizabeth or Natasha, if you had anything to add to that.
Yeah, I mean, I think the only thing I would add to what John has said is, I think one of the things where we see a real great opportunity is it is for, the private sector to lead, I think, in terms of just building out a framework and giving guidance. I mean, I think a lot of the development that we've seen in Europe has really come from a regulatory directive, which we just haven't had that, push here. So I think it is a great opportunity for associations such as the SFA, and I know, some other private associations are trying to do that. So I think that's where we really see a great push.
Okay, that segues. Oh, sorry, Elizabeth, if you had something to add to that.
Just a lot of agreement there. I think, naturally, structured products are just the last frontier for integration with ESG. You saw the LSTA making a big push a couple of years ago as well with loans around the world. So I think naturally, we're here. I think investors in the US might get a little caught on their back foot with regards to climate disclosures. I think TCFD will be leveraged for using climate disclosures within structured products as well, and they should be ready with those types of disclosures. Agreed with John that we'll continue to see an explosion in green, social, sustainable bonds, as well as CLOs. And I think I'm looking forward to CLOs that have real ESG integration also, not just a screening approach. But I think we can see growth in all of those areas, both from reporting and product creation.
All right, excellent. So that also, there's two questions that segues nicely too, but I do want to pick up the disclosure components and the fact that ESG disclosure is very important to help drive this market, whether that is if you're rating firms. But how do we see the incoming administration possibly changing the regulatory environment or disclosures that are seen for both issuers as well as investors? If anyone has any thoughts there.
Sure. I think there are a few areas that I think about. Clearly, it's really hard to understand, at this point, what any administration could potentially bring to bear. But I think there's several areas where we've seen a lot of discourse over the past 6 months. I think the SEC might be thinking about what does ESG mean and addressing greenwashing and what type of regulatory framework they might put around the label of ESG. I guess there could be something done in that regard. The DLL has had a lot of discussion related to ERISA and ESG and how one should think about investing in an ESG product for an ERISA fund. I think we could see some, thought there that might be a little bit different than what have been in the current administration. I think we could look to Europe to see what was happening with the sustainable finance disclosure regulation, and could some of that be brought over? I think climate and carbon risks are clearly the most common issue that I've seen across Europe as well as the US. So I could see more disclosure regulation related to those specific topics. But even away from what the administration might do, I think first and foremost, we receive a lot of client requests related to ESG topics. So I think, that's really where I see the most amount of ESG related information, that I'm asking issuers to provide, is to help me facilitate answer client questions.
And in the absence of information from issuers, so how do you encourage that disclosure? It is just engagement one-on-one, or how would you kind of push this to ensure that you're getting that information from those that are not proactively reporting?
For myself, it is engagement one-on-one. Every issuer meeting that I have, we bring up the topic of ESG, ask them about, do they have an ESG framework? What type of ESG reporting they have? Try to explain to them why, we're asking these questions and what our clients are asking us to provide to them, and why it's important for them to develop some reporting framework. I think it's, it's still very opaque, as I said, in terms of what the actual ask is. And the diversity of questions that we get from our clients is great. And so it's very hard for an issuer to say, answer 100 questions for 100 investors that they have. I mean, they don't have the bandwidth to do that. That's why I think we do need to have a better taxonomy and a better framework, as an industry to think about, how to address ESG issues. But it really is one-on-one engagement. Unfortunately, if you have 100 investors, issuers don't have the staff in order to engage one-on-one with 100 people.
And go ahead, Alex.
If I may, I mean, I won't comment on the incoming administration in the US, but a few things on what's coming in Europe, because taxonomy is not the whole story. First of all, I'm sure you know that Europe just adopted the so-called New Generation EU, 750 billion funds for supporting the recovery, the economy. I think 37% or thereabouts are committed to green. So that would probably trigger further green issuance, further social bond issuance, and will support the market. But that market will develop within the so-called action plan for sustainable finance. And the EU taxonomy is just one element of that sustainable finance action plan. It also includes mandatory corporate disclosure, which is coming. It includes benchmark for low carbon emission and includes the green bond standard. The green bond standard is going to replace the so-called green bond principles, which were established by ICMA, more of an industry approach. And they will probably be tighter to some degree by the compared to the green bond principles, because they will include several additional elements. One is compliance with the EU taxonomy. Two, mandatory verification, if that comes through. It kind of boils down to the point I made earlier, similarity to STS verification, and then mandatory reporting, and there'll be some form of compliance or framework for compliance which has to be enforced. So there's a lot more coming. It sounds like the US administration is not going that route, but we may see Europe being much more proactive in that space and trying to establish standards, not so only for Europe, but probably trying to establish some form of global standards and global leadership.
And so we've been talking a lot about regulation and the different approaches. A question that came in is whether we feel that the regulators are best positioned to establish a framework for, say, the structured finance space, or if this should be driven by the market, and similar to what we've seen with the loan associations and ICMA. So any thoughts on who's best positioned to support that?
It will be a combination of both, but I'm sure the private markets, the private associations will most likely move it just quicker, just because we've been engaged in the conversations. And I think similar to what we saw, post the financial crisis, the involvement in just establishing, for instance, like the reps and warrant frameworks, that really, I think, just came from the private associations, working with the market participants to move it forward.
I would hope that an organization like SFA or the PRI, would have the ability to bring together all the relevant parties to sit down and develop best practices and a commonly understood taxonomy and reporting framework. I mean, I think if by this time next year, and we're having the 3rd annual SFA ESG Symposium, we haven't made any progress on these issues and what do we need to report and how it's reported, then I think it will have been a wasted year. And I think then you have, other parties applying their thoughts, and then we're just going to be reactive as opposed to be proactive and being thought leaders.
Mm-hmm. All right, so just shifting to some of the questions that have come in from the audience. All right, so in this structured finance space, are investors looking at the credit impact from ESG risks that have at different tranches down the capital stack, or is the focus at the transaction level on the whole, not distinguishing ESG credit impact on senior bonds versus junior bonds? Does anyone want to take that one?
Sure. From a credit perspective, I think it's a combination of the two. Certainly, we look at the overall transaction and the utility of the widget that's going into the securitization. But you can have different ESG ratings across a capital structure, even just thinking from a governance perspective. You know, certain tranches are better protective or better voting rights or better protections than others. And so I think you clearly can have different ESG scores within the same securitization.
All right, we have another question that's focused more on the private equity stance. So how would you recommend private equity work with banks acquiring distressed credit in combining the ESG support to build responsible ESG awareness for each asset type? Kind of a broad question, if anyone wants to tackle that.
Well, I think in general, corporate and investment banks are growing exponentially in their knowledge of ESG. It's a huge opportunity for banks to brand themselves, to provide advice, to grow their green business. It's a growth area for them as well. So they will naturally be incentivized, to learn more and more about ESG. On the sell side desks, these employees are now very articulate when it comes to ESG. So I think you'll naturally see a lot of incentives for this to naturally grow in the coming years.
I will note that we have seen the uptake of kind of the application of sustainability linked loans, even in the private equity space. And so trying to incentivize whether that is the portfolio companies that they're working with or the oversight of ESG issues within portfolio companies to improve performance, as taking the similar stance that we've seen with the loan associations and the sustainability linked loans. So very, very good point, Elizabeth. All right, and another question, I think this is to John. So when you're referencing client questions, do these tend to be institutional or corporate clients, or is this more for retail products?
I think by the very nature, it's more to institutional and clients, as well as consultants who come in and ask, give us our RFPs to respond to. But I think FAs certainly do ask the questions, and they also bubble through the correct channels. And so I do think the retail base also is interested in ESG products. And I think that certainly, just in talking across, colleagues across the floor, everyone has an ESG question and wants to know about it, and they're thinking about ESG related funds. So I think all of the above, but clearly it will be the larger institutional investors as well as the larger consultants who are coming in with the questions primarily.
All right, excellent. Well, we are just about at time, so I don't know if anyone wants to make any parting comments, but I really just want to say thank you for taking the time today and chatting with us. But I will leave the floor to you if you have any kind of final thoughts. All right. Well, with that, again, thanks so much, and hope to see you all next year, but be working with you in the meantime on this all. So have a great rest of your day.
Thank you. You too.
All right. Thanks. Okay.